Hello, everyone. Welcome back to the Crypto My Money Show. My name is Martin, and as always, I am joined by Joel.
Hello, everyone, and welcome back.
Well, markets have been a little bit crazy this past week. What's going on, man?
I know this last week was a little bit wild, and not only the stock market, but the crypto market. On the stock market, it was mostly due to the most recent Fed meeting that happened not that long ago, where they actually started getting a little bit freaked out by the inflation, or at least that's the sentiment that the market kind of got from that. Where now they're moving up their projected rate hike to happen a lot sooner, like I think a couple months, if not a year. So I think initially it was scheduled to happen in 2023, and now there's talks that it may happen, next year, 2022. So that kind of freaked out the market a little bit, and I think some of that kind of carried over to the crypto market as well.
Yeah, and it looks like the dollar rallied a little bit as well, and it appears that there's a somewhat negative correlation between the dollar index and Bitcoin. And of course, if Bitcoin goes down, most of the digital asset market follows it. So I guess whether we like it or not, there's still a lot of correlation between digital assets and what happens in traditional markets like equities.
Definitely. I think a lot of that has to do with the fact that a lot of people are seeing crypto as an investment asset, right? And obviously to buy crypto right now, to get into crypto, most people convert the dollar into crypto. So, a fluctuation in the value of the dollar, I think the correlation there is expected uh, to happen with crypto and the dollar.
Right. So, in the midst of all this news, it's perfect time to talk about volatility. Volatility is that scary word that keeps a lot of people from investing in assets that are seen as riskier, but that also have a higher potential for upside.
Yeah, definitely. Volatility is that one factor that could, I mean, essentially make you or break you, right? If
Yeah.
volatility happens on your side, if it just goes up instead of down, then you can make a lot of money. But if it goes down, then you can lose a lot of money as well.
I see there being two sides to the story of volatility because, as an example, when we were growing up, we would hear the advice of having 60% of your portfolio in stocks, which were seen as riskier, and 40% in bonds, which were kind of the well known, established, this is where you put your money if you want it to be quote unquote safer, and safer relating to there being less volatility. Now, bonds don't really work anymore due to the inflation and the fact that your real rate of return on bonds in general is negative now when you take into account inflation. But for the longest time, bonds were seen as that uh, asset of stability where you put your money. So when the stock market crashed, your entire net worth wouldn't plummet with it, even if it's only temporarily, because as we've seen with the stock market and with digital assets, even if there's a crash of 40, 50, 60%, there's always a recovery. As long as the fundamentals are there, there's a recovery if you're willing to stick it out long term. But there's something special about seeing those numbers crash that instills fear and pain into the investor.
Volatility is something that that in many ways plays with the person's emotions, really. And like you said, like you mentioned, right, there's many different types of assets that tend to cater to those emotions, to those needs of an investor. Like for example, a bond, right, it's relatively unvolatile because the interest rates are so low, and it hardly ever fluctuates by that much versus the stock of a company that tends to fluctuate a lot more because, well, there's a lot more risks, right? The bond market is backed by the U.S. government that has to printing press versus a company, could go broke, in theory, the next day. So yeah, volatility,
Yeah,
very, very, very interesting.
yeah, and if you're watching this video, we're assuming that you're wanting higher appreciation. So you actually want volatility. It's your friend because an asset that is stable, say for example, bonds, you're not going to lose money on paper with a market crash quite as much as you would with digital assets or equities, but you're also not going to get the appreciation in the long term. Your bonds are not going to double in value, or the money you have in bonds is not going to double in value. Whereas in the digital asset market, you're going to get those massive gains, just as you're going to get the crashes, right? But there's strategies through which you can protect and minimize your downside while taking advantage of the volatility in your advantage, which would be the upside. But I mean, it really comes down to volatility is the price you're paying for those massive gains, right? It's great and all when you're in a bull run streak and you're experiencing the market going bonkers and you see your net worth rising by hundreds or thousands of dollars per day. And then when that crash comes, it's the opposite, and you feel those scary emotions and the uncertainty. But it all comes with the territory. And frankly, if you can't handle the volatility, then you don't deserve the gains. That's what it comes down to. Are you in it for the long term, trying to maximize your upside, or are you looking for stability? If you're looking for stability, digital assets might not be for you unless you're looking at putting some of your money in stable coins, as we've discussed before.
And volatility can also be thought as risk, right? If obviously, if you're willing to take more risk, the rewards are higher. If you're not, then rewards are smaller. That's the nature of it. So, yeah, going back to an example of bonds, right? Right now, the 10-year bond, the interest rate is like 1.4%. And that's, as we know, the last report that came out on inflation stated that inflation is like 4%. So if you invested in bonds, you would actually have a negative return because it's not even keeping up with inflation. And again, that's because the volatility of bonds is very, very minimal. And so it's a lot more stable. It's a lot more secure. Versus
it's stable in the sense that you're not necessarily losing as much value as denominated by the dollar, but you're losing purchasing power. So I guess in a sense, that lack of volatility is actually hiding the fact that you have a hidden risk through the loss of purchasing power in the long run.
Yeah, exactly. And that is something that should be priced in probably, but it's not.
Yeah.
Yeah, exactly. But I don't know about you, but when I invest, I want to make money. Like that's the purpose, the goal of investing. At least
Yeah.
at my age. So that's why when I think about volatility and I think about especially in the crypto market, I get excited about that because that's where the opportunity to actually make a very decent return.
Yeah,
Especially.
if you focus on high quality projects, you can go into this with a long-term mentality. You can put your money in, invest in a few projects that you deem as quality and having long-term potential, and just sit back. If the volatility scares you, don't look at the price every day. The only reason why you would need to look at the price every day is if you're day or swing trading. But that's contrary to the long-term mentality, and that's a whole other beast. Personally, I don't day trade. I do very little trading, almost none. More than anything else, I'm looking for things where I could put my money and let it do its thing over time. And while I'm waiting for it to do its thing, I'm doing research on other investment opportunities and trying to understand where the market's going.
Same here. More in it for the long term, and long term wise, if a person looks at if a person just invests and doesn't look at the prices at the daily price swing, then it not only is it better for mentally in terms that you're not always thinking about it and not freaking out if there's a dip or not, but just believing and knowing that it will go up. But again, this is based on everyone's personal research and beliefs, right? I mean, personally, I do believe in crypto. I do believe that in the long term, it's going to play out very well. The returns are going to be very, very, very strong. Near term, though, we all know that things are still kind of figuring themselves out. There's still a lot of speculation, a lot of things of whether Bitcoin or crypto in general is the future. I really do believe that it is, just given the fact that it solves a lot of society's problems and solves a lot of efficiency issues. So long term, I have no doubt that it will play out. So like you said, when I think about crypto, I think about it in the long term. Short term, if I was just thinking about it in the short term, I probably would have gone crazy by now, just because of all the wild things happening in the short term.
Yeah, absolutely. You definitely got to go into this with a mentality of only investing in things that are high quality, unless you're willing to stomach the additional added risk of speculating. And we've talked about that a little bit before. If you're looking at something like Bitcoin, it's pretty well accepted by now that Bitcoin is a store of value, and that's how people are, and institutions are looking at it. So it's pretty safe to put your money into Bitcoin, relatively speaking, compared to other digital assets, and just let it sit and ride the volatility. Whereas if you're putting something into a brand new project, then you might have to look at it more closely, because the volatility is crazier, and if the project doesn't go anywhere, then you can lose all your investment.
And I think the another concept or a concept from the stock market that could be carried over to the crypto to the crypto side of investing is that, you know, invest only on the crypto that you know have done your homework on, and you believe and understand to some extent. Kind of like when you invest in the stock market, right? You tend to, or at least what professionals say is to, if you're just going to invest in one stock, invest on that company that, you know, that you understand their business and that you believe in them, that you see that, you know, that growth potential. For example, you know, if you go shopping to Costco and you really like Costco and you're always, you know, telling yourself, man, I wish I would have came up with the idea of Costco because it's just so awesome. I don't see it ever, you know, ever going bankrupt or ever, you know, really losing value rather than gaining value. And, you know, you look at their 10K, you look at their financials, and, you know, you see that it's actually doing pretty strong, and you believe in it. And then, you know, that's you know, then that would be a pretty good stock to invest in. So I would say, you know, some of those concepts also carry over to the crypto market, right? You know, do your research. I, I know the underlying technology of crypto can be a little bit complicated, but, you know, if you understand the fundamentals, the potential, the possibility, then, you know, and you believe in it, then no, go for it. At least that's how I approach it as well. At least when thinking about specific crypto assets.
Yeah, it's important to come into this with an investor mentality. And in my case, I come in with the mentality of building wealth in the long term, not a day trade or swing trade mentality. So I'm investing in projects that I believe in. I believe in their fundamentals. The fundamentals being the team, the idea, the problem they're trying to solve, the proposed solution, all those things. And what I find is that the market, any market, even, it's not just digital assets, but the market is very finicky, and people panic very easily, sometimes over old news that just gets recycled as something new. As an example being the recent crypto ban by China. The ban was already there. China only clarified it again, and the news made it seem as it was something new. They were, I mean, in my opinion, I think there was some manipulation going on, but regardless, it caused the market to panic. And I asked myself this last month when it happened, has anything changed fundamentally with anything that I've invested in? The answer was no. So I've trained myself to see those dips. And when I see the dips, rather than panic and try to exit at a loss, I have some cash on hand ready to buy more of what I believe in. Because if there's FUD, fear, uncertainty, and doubt in the market, and nothing has changed fundamentally, the technology hasn't been changed, there hasn't been a hack, nothing's been broken, and there's bad news, well, you know, I'm looking at this from a long-term perspective, so I'm ready to buy. I see digital assets at a discount. I live for the dips. That's where you make or break your net worth.
Right. Buy low, sell high, right?
Exactly. Yeah, everybody talks a great game, but as we saw in the crash of last month, the people that were selling at a loss to begin with, but they were investors who had held or who had invested less than 6 months. And it was all the old G's and the whales that were buying. Now, of course, eventually in any market, you'll start to reach a point of euphoria and things will get bubbly. you'll know that's the case because everybody's talking great about the asset and everybody and their dog is investing. When you start to feel that things are getting bubbly, of course, your strategy will probably change. Maybe you stop investing and you start exiting using something like a ladder exit or something like that. But yeah, there you kind of want to invest contrary to the emotions of the market. When there's fear and panic, you buy. As the old saying goes, when there's blood on the street is when you ought to be investing. And when everybody's feeling super great and the prices are going sky high and crazy is when you need to start looking at what your strategy is going to be. If you still have long term, or if you still believe that the project has long term potential, maybe you just ride it out. You stop investing, you wait for the peak and the crash, or you continue dollar cost average. If you believe that the fundamentals of whatever you have invested in has changed, then you can look at a ladder out strategy into cash, or my preference would be stable coins, because with stable coins you can still earn 8 or 9% interest and you're not just having that money burning in a bank account. But you got to ask yourself and be very clear with what is it that you're trying to accomplish. In my case, I'm young and I have a lot of runway, so my risk tolerance is a lot higher than, say, somebody who is 40 years old and thinking about retirement in 20 or 25 years.
So it's almost like all those fundamentals that get applied to the general stock market can be applied to the crypto market, right? Because that's also what it's sounding like. Like a lot of those can get applied. The only really big difference is this: that crypto is a lot more volatile than the stock market, because I mean, it essentially is still really unknown how it's going to play out. It's still at its infancy. So the volatility is to be expected, but a lot of the goals of what a person tries to achieve with the stock market, I think, can be carried over to the crypto market as well. With that caveat of it's going to be volatile, at least in the near term. Long term, well, long term as well. I think, but I think if a person also kind of thinks on along the lines of what would I do if I was investing in the stock market, and then kind of move some of those fundamentals over to the crypto market.
Yeah, absolutely. I love digital assets, not just for the technology and the potential from the investment side, but also as an education. Things move a lot faster in digital assets, and the volatility is part of that. But I also see it as a perfect learning experience. For me, as an example, it's done a lot to fortify my my focus, and also has taught me to detach emotionally from the price. And as things swing up or swing down, I've learned to moderate my emotions more and not get carried away, right? It goes both ways, because if you allow yourself as an investor to get really excited with an upswing, then when things start to dip, you're going to be more susceptible to the emotion of fear. Now, with digital assets moving faster, it seems like the cycle's a lot shorter, whereas in the traditional market, we see business cycles of, like, say, 7 to 10 years. Within a period of a few months, you will experience euphoria and straight up dread and panic in digital assets. So that's why I like it a lot as well, is because I'm learning to apply these fundamentals, and I have every few months I've got a big opportunity, or sometimes multiple opportunities, to apply. When things are going up, I use my exit strategies to capture some profits and reinvest in projects or exit into stablecoins. When things crash, as for example the dip of about 40% last month, I automatically get into shopper mode and start converting my cash into digital assets.
And I'm curious, what are your thoughts on the volatility for crypto assets? Do you think it's gonna get more wild, or do you think, from your experience, since you started investing, has it kind of started, being smaller, the volatility?
No, the volatility is still there. Since 2017 when I've invested, the volatility has been about the same. In the long run, the volatility is slowly being reduced or slowly reducing itself in top assets, primarily Bitcoin. Bitcoin is probably the most stable, believe it or not, even with the massive 40% swing. That is actually pretty stable compared to other projects. And say in 5 to 10 years, when institutions have invested in Bitcoin and everybody's in Bitcoin at some degree of exposure, Bitcoin is going to have a lot less volatility, but there's also going to be a lot less upside potential.
That's a good point. And I think if you are to look at the changes in percentage price of Bitcoin, you would probably start seeing that, right? Going back from its from when it just barely came out to now, like the percentage swings are probably at least a little bit smaller now than what they were back 8 years or so ago, or even 10
Yeah,
years.
so Bitcoin has had 3 crashes of 80% or more. 3 crashes. And the crash that we had last month was about 40%.
Great time to
Yeah,
buy.
it's still a great time to buy. The market has been trading sideways ever since then.
Mhm.
And so I want to give another parallel too of Amazon as a company that everybody knows and loves. It started before the dot-com boom and then subsequent bust, the crash of 2000. And with all the other tech companies, Amazon stock went up. And then everything crashed when that bubble popped. And month over month for 2 years, the Amazon stock kept going down in value. And the price kept going down and down and down. At one point, the price fell 90% from its highs of the dot-com bubble. 90%. That's pretty comparable to the 3 crashes that Bitcoin has had of over 80%. That wasn't necessarily a testament to Amazon. Again, the fundamentals were there. If you were a shareholder that was keeping up with Amazon and getting their letters from Bezos that he sent out to the shareholders, you would know that they were hustling and getting the infrastructure in place to grow, but their stock was victim to the sentiment of the market, and the entire market was in a bear cycle after a period of euphoria. So nothing had changed with the company, but it lost 90%. The stock lost 90% of its value with the market. So that is how digital assets are as well. Sometimes news related to digital assets will cause prices to go down significantly. Sometimes it's fear of crippling regulation or whatever. But if the fundamentals are still there, then history has taught us, just like Bitcoin, just like Amazon, if the fundamentals are there, the price will always go up. So if you had bought Amazon stock at the peak in 2000, at the very peak of the dot-com bubble, right before it burst, and you held it until now, you'd still be up 30x. If you would have ridden that wave from the peak down, watched your portfolio or your allocation to Amazon lose 90% of its value, just let it sit for another 20 years, you would be up 30x.
And that's wild. That's pretty crazy. Right, but I bet if a person was at that point back then, near term, yeah, probably would have been very, very, no, very scary, especially if you were about to retire, right? So this goes back to, assessing, what are your goals, your needs. I mean, if you would have invested, on Amazon back then, at that point, you were about to retire, then, probably would have been a different story. But if you were, relatively young and just looking to invest for the long term, then that would have been a very, very smart move. Even if you would have, like you mentioned, bought at the very peak, right?
Yeah.
Uh,
Same thing with Bitcoin. If you would have bought at the peak or near the peak of the peak of the last cycle in 2017, 2018, you'd be up 2x. Now, you would have been up 3x before the crash of last month, but we're in a bit of a correction reaccumulation now. So if you just continue to hold, you're going to continue to multiply. But as you said, it all depends on your appetite for risk and also where you're at time horizon wise. Because if you're looking to retire, then digital investing in digital assets that are speculative is going to be more is going to have more risk in the short term. Something like putting your money in stable coins might be better for you.
That's true, or at least just allocating a small percentage of that portfolio just to crypto assets, right? To where it's the one that wouldn't really impact you as much if it went down in value, but could be give you a nice return if it went up in value. And to your point as well, I mean, I think I think there's still some projections out there that Bitcoin could still reach 100,000 here in the next few years. So if a person would have bought the most recent peak of like 64K when it was about 64,000, I mean, I bet, if a person wants to look at that in the near term, they would probably be freaking out and probably pretty anxious, especially if it was a good amount of money. But, long term, the projections are there, that the optimism is there that it will rebound and reach that $100,000 value. So I think right now, even what Bitcoin is going through is a learning lesson by itself.
Yeah, and the best way that you can learn is by playing the game. If you're worried about the volatility, start small, invest only what you're willing to lose, and use that small investment as an education. Think of it no different as if you were to invest in an MBA. You're going to have a sunk cost up front. Think of your investment as a sunk cost and look at it as, okay, I want to get comfortable with this. I'm going to set aside $1,000 or whatever small amount of your portfolio you're willing to lose, put it into an asset you believe in, and learn from the experience. Learn to manage your emotions and to temper the highs, but also to numb out or detach from the lows.
Exactly, and that could be a pretty smart move for for the future you. But again, like you mentioned, it's all depends on the person's appetite for risk, right?
Yep. And of
Um,
course, everything that we talk about here is just based off our personal experience, and we're not financial advisors, so don't get your financial advice from people on the internet like us. You gotta do your own research and figure out your own strategies because at the end of the day, you gotta do what's best for you.
exactly, and only you know what's best for you.
Yeah. So make volatility your friend. That is the moral of this story. And if you've got questions on volatility or market, the cycles of digital assets or specific digital assets, leave your comment and let us know what other things you want us to discuss in this show.
Exactly. But I do gotta say though, volatility is one of those things that has been overcomplicated if a person tries to do their own research on the internet, right? So it's like just
Yeah.
also do your diligence and and read stuff that you trust as well. Because that is volatility something that I think the overall financial market it has learned to capitalize on to some extent by making it complicated.
Yep, absolutely. I think there's nothing better than invest in things you believe in, sit back and enjoy the ride and laugh when people are panicking and chill out when people are super excited. I think it's a lot of fun watching all the emotions of the market and the pundits on media. And don't take things too seriously.
Exactly. And I mean, there's always panic every day. If it's not
Yeah.
one thing, it's another. So, yeah. So, like I say, I'll make volatility your friend and just enjoy the ride. Because if you are to look back in history, volatility has been an investor's friend in many situations.
Yep. So with that, we're going to do a wrap on this show, but we'll be back next week with another topic. So stay tuned. Till then, take it easy.
Exactly. So be sure to hit like and comment. Until next time.